Today, folks, this is the most valuable video you will watch at the beginning of 2024 when it comes to the S&P top 10 tech companies. We are going to be reviewing the balance sheets, the price to earnings, the revenue growth of all these companies so you can get a fair idea of what you would consider a value play in the S&P top 10. As I personally believe Google is the most best value and why I've been putting all my money in it. And you're going to see that as we break down these fundamentals. Now, if that is a conversation you appreciate, hit that like button because your mind is going to be blown, baby, when we're talking about these growth companies like Nvidia, like Tesla. If you are a nerd like I am, go hit that like button and consider subscribing if you're on a path to financial independence to perhaps, damn it, one day retire early like I am. But this week has been a continued week of growth up to the last day or two here where we've been seeing Tesla correct dramatically. Bitcoin has been pulling back dramatically. A lot of controversy around Bitcoin and the crypto ETFs, and we'll discuss that on the live stream. I'll be doing that on Sunday, so subscribe and hit that bell notification for those updates. But I really just want to kind of core focus on why I've been loading the boat on Google and why most of these S&P top 10 tech companies are actually really awesome, and they'll likely continue to be. But we'll take a look first and foremost at Google here. Now, Google's got a little ways to go before it hits its all-time high. It has offered a stellar 5-year return of 157%, and I think it's going to continue to be one of the best returning companies because it is mostly software-based, and we're going to see that in comparison to Amazon and Microsoft. But still, their revenue has consistently gone up. They're sitting at an all-time high revenue. The growth is coming back. The growth never went negative, even into this kind of recessionary environment. But we'll notice that the stock price has been really following the earnings per share. The market kind of gave up on the idea of growth. It used to be small caps, anything growing, who cares about earnings, to we only care about earnings, and you can see that in the performance of the stock. Now, Google stock's rallying into basically up before Q4 earnings because there's a lot of anticipation for a continued earnings growth, right? So we can see if you look at this bar chart, it looks very, very similar to Google's bar chart. Now, what makes Google most attractive to me is the NAV, the net asset value minus the liabilities. With 365 billion in assets and 109 billion in total liabilities, they're sitting on what? A whopping 200 and an ungodly amount, like 250, 40, something crazy billions of dollars, right? Which is incomprehensible compared to a lot of the companies we're going to look at incomparable, even Amazon. Like, take a look at Amazon here. Now, this company's only up 82% in the last 5 years. And if there's one thing Amazon is renowned for is revenue growth. We are in a stage of transition from brick and mortar to obviously e-commerce. And, going through one of the worst market environments ever. Yes, Amazon's growth slowed down, but it stayed pretty much in the double digits this whole time. The only thing that really concerns people is that this isn't a high margin business. That's why Amazon has been focused so much on their cloud services. And Amazon spent a lot of money coming into 2022. And when the market got a hit and they went negative on their earnings per share, people said, we don't want this. And Amazon recognized this. A lot of companies did. That's why they did layoffs. That's why they refined and dying their businesses. And that's why earnings started to recover. And again, you can see that in Amazon stock price. I mean, it has been coming back really in line with the earnings per share, right? So something to pay close attention to. But what's neat about Amazon here is they do have still a resilient balance sheet with $462 billion in assets, some of the highest asset balance sheet of the S&P tech companies, if we can define e-commerce as tech. But still, when you take a look at the liabilities, they are sitting on a pretty healthy chunk of around 300 billion, give or take. So they're probably sitting on about 150, 160, again, just rounding numbers here in underlying assets. Not as good as Google, but keep in mind, they are just a behemoth and an unimaginable, just imagine $462 billion. So they sit at the top of asset values. But Apple is the most intriguing case study of 2024 because Apple, I do not think, deserves anymore to be the largest company basically in the markets. It just doesn't deserve it in comparison when we compare directly to Microsoft. Even and Microsoft's coming for their lunch. Their market caps right now are at an incredible pace. They're both pretty much equal in market cap value. But depending on what this earnings does will really dictate who takes the crown. Because Apple here, they haven't had any revenue growth. Though it hasn't declined dramatically, it hasn't really grown either. Same with their earnings per share, yet the stock has been going up. This is a concern for overvaluation, especially when we get into their balance sheet where they have 352 billion in assets and basically a total liability of 290 billion. So, I mean, their total assets are under 100 billion. I mean, it's what, 60, 70 billion maybe? That's very lackluster when you're comparing it to these other companies, but they do have a moat. Nobody's replacing iPhones. Nobody's taking their lunch. They have a long runway of crazy amounts of earnings to cake in, and maybe that's why people are valuing them so highly. But as an investor, you're looking for growth because you have to justify those earnings and what you're paying for those earnings today, right? And honestly, if you don't understand a price to earnings multiple, Presuming Apple doesn't grow at all and their earnings never change, it would take 30 years for you to get a full rate of return on your money. That's the idea of a price to earnings multiple, right? Nobody wants to wait 30 years. You have to come to that fundamental reality that it doesn't matter how good your moat is, you need to grow. So taking a look at Microsoft in comparison, which again, Microsoft's up 260% in the last 5 years. Apple's taken the crown at 374%. But again, this could change pretty dramatically here in just a couple of earnings quarters because Microsoft, again, has continued to grow. They got hit not as bad as Apple, but they're sitting at an all-time high revenue. They're sitting at an all-time high earnings per share. You can see that the stock has gone parabolic in anticipation of the next earnings cycle. A lot of AI hype, a lot going on. Look at the assets, incomparable only to Amazon, $445 billion in assets. What was Amazon's again? I think Amazon was sitting at what? 462, so just slightly below Amazon, but they only have 225 billion in total liabilities. So a lot less liabilities than Amazon, giving them probably, you know, more in line with Google-like underlying NAV values, because you minus that out, they're sitting on what, 220, give or take, or yeah, somewhere around there, $220 billion in underlying assets. So Microsoft's very intriguing, right? And being a software company, the margins clearly are working into their favor, unlike Apple. And again, this is the comparable between Google and Microsoft and some of these Amazon and Apple-like companies where they actually have to sell products, because Google and, you know, Microsoft are selling software a lot less than they are actually selling physical products. So let's use Meta, the best recovery play that we've ever seen. Meta tanked, was one of the worst hit stocks ever, and one of the greatest recovery plays we've ever seen in a crash-like scenario. And they are getting very expensive again because people are anticipating a lot out of this company, because they are sitting again all-time high revenue. They are sitting again towards some incredible earnings per share growth after doing a multitude of layoffs. After a lot of people came in concern with their, you know, Reality Labs, they smartened up, because again, people want earnings. They do not want revenue growth. That's what the market was before the crash. But now we got to see if we're going to head back into a growth market where people are more concerned, you know, about revenue growth than perhaps they are about earnings growth. But for now, this next earnings, this Q4 will be a defining factor to that, right? But take a look, because Meta's sitting on $216 billion in assets and $73 billion in underlying liabilities. They actually have a better NAV value than Apple does. I mean, they're sitting somewhere in the 100, if I had to guess here, what, maybe $140, $150 billion range. So those are the staples, I'm going to call them. These are the companies that I think you could buy and you'd probably do very well over 20, 30-year period. Sometimes they're overvalued like Apple, but they'll come back into favor at some point, and they kind of these cyclical flows, which is why it's good to own the ETF like the SP 500. But where things get most intriguing is in these growth stocks, because they're heading into a pivotal phase where if the market only cares about earnings, these stocks could very potentially be in trouble. Now, Tesla's the end-all hype beast of any company that's ever existed, right? And there's still a lot of reliance around self-driving and robotics, but we've been promised a lot and we've also been under-delivered on a lot. That doesn't mean it's not coming. I want to buy Tesla, sorry, but Tesla's got to come down to the right price. I think Tesla's branding power is put it in the league of Apple. It's just got to start proving that branding power's capability, and sometimes that can take a long time. I mean, we've been down now for what? Going on 3-4 years, right? I mean, we could go on to another decade with no growth out of this company at the rate that it's looking, because, you know, you look at revenue, and revenue's great. Yes, we're getting continued revenue growth, but it is slowing into the single digits. And we also have price to earnings here when it comes to their EPS declining because their margins are shrinking, because people just in a high interest rate environment don't want to pay as much for cars. And, you know, Tesla claiming that they're a software and robotics company doesn't make revenue from software or robotics yet. I think that day is coming, but you're speculating, and it leads to volatility and concern in the stock price, right? It could lead to big movements and requires a bigger stomach. Now, asset values, you know, this is where things kind of just, you know, we can understand though, because their market cap's not as big. But when you're talking about a company that has $93 billion in assets and total liabilities of about $39 billion, I mean, they've got a pretty healthy balance sheet, but around $52 billion in underlying assets, nothing comparable to a lot of these bigger companies. But again, we're only talking about a $600 billion market cap. We are not talking about the scope or the scale of, you know, Google or Apple or Microsoft. So keep that in mind. So the thing with Tesla is we keep seeing the stock price decline followed by rallies of hype, because the company isn't really generating any hype from their revenue or their earnings per share. So, you know, Tesla might announce a cheaper car here soon. That could really propel the stock, even though it's not going to add a fundamental base to their income yet, right? So I'm hoping, and again, I'm not trying to be bearish on Tesla. I think the price is too high today, but long term, I'm incredibly bullish. And I really want to buy some. And I told you, if this thing can get under $100 a share and stay down there, and I can start cost averaging into it as it declines, like it did back here, right? Like this was the dream. If we can get back down in this area from 100 to 200, that's the buying capacity for me. And I could be wrong. Maybe it tanks even more than that, or maybe it doesn't get there at all. I don't know, but I always have a hard time stomaching when I can read these balance sheets and understand that, companies like Google actually have a fundamental growth rate ahead of them and high margin businesses. And, that's going to lead to better returns in the near term. And as somebody that wants to retire early, I want to pay attention to those near term returns. So near term, NVIDIA, the most fascinating growth stocks, which will be a case study amongst case studies, is can NVIDIA in the next year pace its way up to Apple? Because honestly, if people only care about earnings per share, let's talk about it. Because when you look at the revenue, it is off the freaking chart. It is nowhere near close to Amazon. It is nowhere near close to Apple, but that doesn't matter. It is the highest margin business that currently exists today. And if people only care about the bottom line, when your bottom line is generating net income of over 10 billion in a quarter, and it's likely you're going to get up to 15 and 20 billion, which if we can get to 20 billion, I mean, that's where we're getting into Apple's level and Google's level, right? So who cares about how much revenue you're making if it's hitting the bottom line at 10 to 20 billion? That is insane. That is unbelievable. But that's because NVIDIA has been able to offer 70, 75% margins, which none of these tech companies come close. Even Google, I think, has 30% margins. And, it doesn't really matter if they can keep those margins up and continue to double up their revenue every other quarter like they have been. They are going to be competing for Apple's lunch here very shortly, but this is highly unsustainable. People are aware that these growth rates, just because they look good today, you give it a year or two and that people are going to come and compete for that. Like, you can't be making that kind of money without competition, and you can't be making that kind of money knowing that people aren't going to be buying this product the way they are into the future forever. That was like the crypto run, right? Back here, this was the crypto run, guys. That's all the CEO of NVIDIA couldn't shut up about was a crypto mining, crypto this, crypto that. And then crypto fell off, and then the stock started to fall with it, especially as the market started to decline and people weren't buying graphics cards for their computers and all that stuff like they were. But then as soon as ChatGPT came around and AI and, all this software expansion, and people are like, well, it's not a bubble, because there's actual use cases for it. Well, newsflash, there's use cases for NFTs and there's use cases for crypto, but it takes time for that stuff to really bake in and prove earnings per share, right? So all these companies that are building these AI software might not be seeing the direct result today because it's still in its infancy, right? But NVIDIA is selling the picks to the miners. But eventually, those miners might soften up on the picks that they need because they will have bought all the picks they need to mine what they're mining, if that makes any justifiable sense, because they're only sitting on 54 billion in assets and about 20 billion in liabilities, giving them about 34 billion in underlying assets against a market cap that's at 1.35 trillion. This is why the likes of Michael Burry have been shorting the chip sector. I mean, there's a lot of concern, and you have to be super careful when you get these massive epic runs because it leads to chasing and disconnect from the fundamental reality. Now, because I don't know what's going to happen, I just keep buying the S&P, and if it starts to underperform, the market cap weighting will go down, and the passively weighted ETF will do its thing and start weighting it away and not eating into my total returns. And then I can hand select a few companies like Google that I think are going to shine in the next earnings and in the next year and the next 3 years, and I can really start pacing this up until these other stocks come more into what I would consider a value favor from my personal perspective. But I am speculating to some degree, and that's why these are very small positions, and individual stocks don't make up much more than 10 to 15% of the entirety of our portfolios or my portfolio. But these are just one man's opinion, and I think this is a fascinating conversation that you should really have with yourself when you think about the value of these companies. But I'll pass that off to you. I'd love to know what you think in that comment section below.